Are you looking to buy or sell property in Florida? You might be overlooking a critical demographic shift that's reshaping the entire real estate market. Florida's elderly population is exploding, and it's not just about retirement communities. We're talking about a ripple effect impacting everything from luxury condos to affordable housing, creating both vulnerabilities and unique investment opportunities. By 2030, more than 1/4 of Florida's population will be 65 or older. That's the highest concentration of seniors in the entire country. And this isn't some distant forecast anymore. It's happening right now, in real time, across every corner of the Sunshine State. According to demographic research from Florida's Office of Economic and Demographic Research, this silver tsunami is already reshaping housing demand in ways most investors and buyers are completely missing. The impact isn't uniform. It's creating explosive demand in specific sectors while quietly suffocating others. Senior living facilities are experiencing record occupancy. Single-family rentals occupied by retirees have surged 70% in some markets. Meanwhile, affordable housing for fixed-income seniors is collapsing under the weight of soaring insurance premiums and skyrocketing rents. Thousands of elderly Floridians are being priced out, displaced, and in some cases, pushed into homelessness. In this deep dive, we're unpacking exactly where the demographic pressure is building. We're revealing which housing sectors are poised for sustained growth, and which ones are sitting on hidden landmines. From luxury assisted living to vulnerable condo markets, from rental explosions to affordability crises, this is the demographic earthquake reshaping Florida real estate. And if you're investing, buying, or selling without understanding these forces, you're flying blind. Hit subscribe to Housing Intel and ring the bell so you never miss market intelligence like this. The affordable housing crisis crushing Florida seniors. Across Florida, the most vulnerable segment of the housing market isn't millennials or first-time buyers anymore. It's seniors on fixed incomes, and they're being absolutely crushed. This isn't just a social issue. It's a market vulnerability that's creating instability in specific neighborhoods and property types, and it's accelerating fast. In Broward County alone, officials estimate a shortage of roughly 73,000 affordable homes and about 74,000 affordable rental units. Meanwhile, rents have climbed more than 70% since 2016. For seniors relying on Social Security or modest pensions, that math is catastrophic. Many are spending 50, 60, even 70% of their income just on rent, with nothing left for health care, food, or emergencies. The consequences are showing up in real time. According to recent reports, older adults now represent the fastest-growing segment of the homeless population in Central Florida. Seniors who were stably housed just 2 years ago are now living in shelters, cars, or on the streets. In some counties, senior homelessness has doubled in less than 3 years. This isn't an anomaly, it's a structural collapse driven by the collision of fixed incomes and runaway housing costs. But here's where this becomes critical for investors and buyers. Markets with high concentrations of cost-burdened seniors are showing signs of distress. Property tax delinquencies are rising. Maintenance is being deferred. HOA fees in older communities are spiking as residents struggle to pay assessments. These are the early warning signals of neighborhoods entering decline. If you're buying in areas with aging populations and limited affordable inventory, you're inheriting that risk. The pain isn't limited to renters. Homeowning seniors are facing their own nightmare. Homeowners' insurance premiums in Florida have surged over 60% since 2022, according to Bloomberg analysis. For retirees on fixed budgets, an extra $500 to $1,000 monthly in insurance costs is unsustainable. Property taxes are climbing, utilities are up. And for those in older condos, special assessments for structural repairs are hitting like financial bombs, forcing some seniors to sell at a loss or walk away entirely. This affordability crisis is quietly destabilizing entire segments of the market. Condo buildings with high percentages of elderly owners are particularly vulnerable. If a large chunk of residents can't afford a $50,000 special assessment for roof repairs or elevator replacements, the building enters a death spiral. Units become unsellable, values plummet, and buyers who didn't see it coming get trapped. If you're finding this breakdown crucial, tap that subscribe button to Housing Intel. The explosion of senior rentals reshaping demand. While affordability collapses for some, another phenomenon is quietly reshaping Florida's rental market. Seniors are renting at unprecedented rates, and the surge is staggering. This isn't a temporary blip. It's a fundamental shift in how retirees are choosing to live, and it's creating sustained demand in specific property types. Over the last decade, renter households aged 65 and older have surged 22% in Miami, over 80% in Jacksonville, and roughly 50% in Lakeland and Orlando. But here's the kicker. It's not just apartments. Single-family home rentals occupied by seniors have exploded. In Jacksonville, single-family rentals with elderly tenants jumped nearly 70%. In Orlando and Tampa, growth exceeded 20%. In Miami, it climbed over 30%. Why is this happening? Several forces are converging. Many retirees are selling homes in high-tax northern states and choosing to rent in Florida for flexibility. Others are downsizing from owned homes but want the space and privacy of a house, not an apartment. Rising home prices and mortgage rates have priced some seniors out of buying, pushing them into the rental market. And a growing number simply prefer the maintenance-free lifestyle that renting offers, especially as they age. For investors, this creates a massive structural opportunity. Single-family rentals in desirable retirement areas, close to healthcare, shopping, and amenities, are attracting high-quality, long-term senior tenants. These renters tend to stay longer, maintain properties well, and pay reliably. They're not looking for the cheapest option. They're looking for quality, safety, and convenience. And they're willing to pay for it. But location matters intensely. Seniors prioritize walkability, proximity to medical facilities, low crime, and community. A cookie-cutter rental in a car-dependent exurb won't attract this demographic. But a well-maintained single-family home in a walkable neighborhood near a hospital, grocery stores, and parks? That's a goldmine. Markets like St. Petersburg, Sarasota, Naples, and parts of the Tampa metro are seeing the strongest demand. The rental surge isn't just single-family. Mid-priced condos in urban and suburban cores are also attracting senior renters. Two-bedroom condos with elevators, secure entry, and minimal maintenance are ideal for retirees who want lock-and-leave convenience. Investors buying these units and renting to seniors are seeing stable cash flow and low vacancy. Here's the contrarian insight most investors miss. While headlines scream about Florida's housing crash, the senior rental segment is showing resilience. Demand isn't evaporating. It's shifting. And those who position themselves in the right property types, in the right locations, are capturing a demographic wave that will sustain for decades. The luxury senior living boom defying the market slowdown. While much of Florida's real estate market is cooling, one sector is on fire: luxury senior living. High-end assisted living, memory care, and continuing care retirement communities are experiencing record demand and occupancy rates that would make most multifamily developers jealous. This isn't your grandparents' nursing home. We're talking about resort-style communities with fine dining, concierge services, fitness centers, golf courses, and on-site medical care. Monthly fees can range from $5,000 to $15,000 or more, and waiting lists are growing. Wealthy retirees from the Northeast and Midwest are flooding into Florida and willing to pay premium prices for premium care and lifestyle. The demand drivers are structural. Baby boomers, the wealthiest generation in American history, are hitting their 70s and 80s. Many are sitting on substantial home equity from decades of appreciation. When they sell million-dollar homes in New York, New Jersey, or Illinois and move to Florida, they have cash to spend. And they're prioritizing quality of life, health care access, and community. Memory care, in particular, is experiencing explosive growth. As the senior population ages, dementia and Alzheimer's cases are surging. Specialized memory care units that provide secure, compassionate environments are in critically short supply. Developers who can deliver high-quality memory care facilities are commanding premium valuations and seeing rapid lease-up. For investors, the senior living sector offers a different risk-return profile than traditional residential real estate. It's less sensitive to interest rate fluctuations and more driven by demographic fundamentals. Occupancy rates in well-managed Florida senior living communities are consistently above 90%, even as apartment occupancy softens. Revenue is predictable, and the regulatory barriers to entry create a moat that limits competition. But not all senior living investments are created equal. Location, quality of care, and reputation matter enormously. A poorly managed facility in a tertiary market will struggle, but a best-in-class community in a high-growth metro like Tampa, Orlando, or South Florida can generate stable, long-term returns. The key is understanding that this isn't a commodity product. Seniors and their families are making deeply emotional decisions about care and safety. They'll pay for quality and peace of mind. Want to avoid missing opportunities like this? Subscribe to Housing Intel and stay ahead of the market. Hidden vulnerabilities in aging condo markets. Here's where the silver tsunami turns dangerous for unsuspecting buyers and investors. Older condominium buildings with high concentrations of elderly owners are sitting on financial time bombs, and most people don't see them until it's too late. The problem is structural, literally. Many of Florida's condo buildings were built in the 70s, 80s, and 90s. Decades of deferred maintenance, exposure to salt air and hurricanes, and outdated building codes are colliding with new state regulations requiring structural inspections and reserve funding. The result? Massive special assessments hitting owners all at once. In some buildings, owners are being hit with $50,000, $75,000, even $100,000 assessments to cover roof replacements, balcony repairs, plumbing overhauls, and elevator modernizations. For elderly owners on fixed incomes, these assessments are unaffordable. They can't pay, and they can't sell because no buyer will touch a unit with a massive pending assessment. This creates a death spiral. Units become distressed. Values crater. The building struggles to collect enough funds to complete repairs. Banks won't finance units in buildings with inadequate reserves, and the entire property enters a state of financial paralysis. We've already seen this play out in South Florida, where some condo buildings have lost 50 to 70% of their value virtually overnight. The risk is highest in older buildings with aging ownership demographics. If the majority of owners are 75 plus and living on Social Security, the financial capacity to absorb large assessments simply doesn't exist. Buyers need to scrutinize reserve studies, maintenance histories, and the age profile of ownership before purchasing in older condo buildings. The sunset views might be beautiful, but the financial reality can be brutal. Insurance is another landmine. Condo buildings in coastal zones are seeing insurance premiums triple or quadruple. Some can't secure coverage at any price. That cost gets passed to unit owners through HOA fees, which in some buildings have doubled in just 2 years. For elderly owners, the combination of soaring HOA fees, rising property taxes, and special assessments is financially suffocating. Here's the paradox. In some cases, these distressed condo markets present opportunities for cash buyers willing to take on risk. Savvy investors are buying units at deep discounts in fundamentally sound buildings, paying off assessments, and holding for the long term or renting. But this is advanced-level investing. For most buyers, especially those financing, older condos with elderly ownership are a red flag. The single-family rental opportunity in senior-friendly markets. Let's shift to where smart money is positioning. Single-family rentals in senior-friendly markets represent one of the most durable investment opportunities in Florida's shifting landscape. And the data backs it up. As we discussed earlier, senior demand for single-family rentals is surging. But the opportunity goes deeper. Retirees want specific features: one-story layouts, minimal stairs, attached garages, proximity to health care, walkable neighborhoods, and low crime. Homes that check these boxes are commanding premium rents and experiencing minimal vacancy. Markets like Sarasota, St. Petersburg, Naples, parts of Tampa, and suburban Orlando are seeing the strongest performance. These areas combine good weather, healthcare infrastructure, cultural amenities, and established senior populations. Investors buying well-located, well-maintained single-family homes in these markets are achieving cash flow, appreciation, and tenant stability. The strategy isn't complicated, but execution matters. Target homes in the $300,000 to $500,000 range in safe neighborhoods, close to shopping and medical facilities. Avoid homes with steep driveways, multiple stories, or excessive yard maintenance. Seniors prioritize ease and safety. Small upgrades like grab bars in bathrooms, non-slip flooring, and good lighting can make a property far more attractive. Rent growth in these segments is holding up even as broader market rents soften. Seniors aren't as price-sensitive as younger renters because they're prioritizing stability and quality of life. They're less likely to move frequently, reducing turnover costs, and they tend to respect properties, reducing maintenance expenses. Institutional investors have already spotted this trend. Large single-family rental operators are quietly accumulating homes in Florida's top senior markets. But individual investors still have an edge in sourcing off-market deals, offering personalized management, and building relationships with senior tenants. This isn't a get-rich-quick play. It's a build-wealth-steadily strategy anchored in demographic fundamentals that will compound for decades. Mid-priced condos in walkable urban cores as a hidden gem. While older condos in distressed buildings are landmines, newer or well-maintained mid-priced condos in walkable urban areas are emerging as a sleeper opportunity. Retirees increasingly want urban or suburban walkability, access to restaurants, health care, and culture without the burden of home maintenance. Two-bedroom condos priced between $250,000 and $450,000 in areas like downtown St. Petersburg, parts of Tampa's urban core, Delray Beach, and sections of Fort Lauderdale are attracting both senior buyers and renters. These properties offer the lock-and-leave lifestyle retirees want, with the added benefit of community and convenience. Investors buying in these segments are seeing stable occupancy and reliable rental income. The key is focusing on buildings with strong reserves, recent updates, reasonable HOA fees, and walkable locations. Avoid buildings with deferred maintenance, aging infrastructure, or high special assessment risk. But in well-managed buildings, these units offer a compelling value proposition for both investment and end-user demand. This is the kind of analysis you won't find anywhere else. Subscribe to Housing Intel now. The insurance and tax squeeze amplifying senior displacement. We've touched on insurance, but let's drill deeper because it's one of the most underestimated forces displacing seniors and destabilizing markets. Homeowners insurance in Florida has become a financial wrecking ball, and seniors are bearing the brunt. Premiums have surged over 60% statewide since 2022, according to Bloomberg. In high-risk coastal and flood-prone areas, premiums have doubled or tripled. Some insurers have pulled out of Florida entirely, forcing homeowners into the state-backed Citizens Property Insurance, which is underfunded and charges higher rates. For retirees on fixed incomes of $3,000 to $5,000 monthly, an insurance bill jumping from $2,000 to $6,000 annually is devastating. Property taxes are compounding the pain. Florida's homestead exemption provides some relief, but taxes are still climbing as property values rise. Counties are raising millage rates to fund infrastructure and climate adaptation, and in areas with high senior populations, tax increases are forcing retirees to choose between paying taxes, insurance, utilities, or groceries. The squeeze is most acute in coastal areas and older inland communities with aging housing stock. Seniors who bought homes decades ago at low prices are now trapped. Their homes have appreciated, but they can't afford to stay due to carrying costs. And selling isn't always a solution because they can't afford to buy or rent elsewhere in Florida's inflated market. Some are leaving the state entirely, moving to lower-cost markets in Georgia, the Carolinas, or Tennessee. This displacement is creating geographic shifts in senior populations. Wealthier retirees are staying in high-cost coastal markets. Middle and lower-income seniors are being pushed inland or out of state. Investors need to understand these migration patterns because they determine where demand is growing and where it's collapsing. Markets seeing senior in-migration, like suburban Tampa, parts of central Florida, and the Panhandle, are experiencing sustained housing demand. Markets losing seniors, particularly high-cost coastal areas, may see softening demand in entry-level and mid-market segments as the senior population thins out. The coming wave of senior homeowner sell-offs. Here's a trend most people aren't talking about yet, but it's coming. Florida is home to millions of senior homeowners who have aged in place for decades. As this population moves into their 80s and 90s, health decline, death, and the need for assisted living will trigger a massive wave of home sales. This isn't speculation, it's demographic math. The largest cohort of baby boomers is now in their mid-60s to mid-70s. Over the next 10 to 15 years, millions of these homeowners will downsize, move to senior living facilities, or pass away, releasing their homes onto the market. The question is, will there be enough buyers to absorb the inventory? In desirable markets with strong job growth and in-migration, the answer is likely yes. But in markets heavily dependent on retirees with limited economic diversification, the inventory wave could overwhelm demand and drive prices down. Communities like the Villages, parts of Southwest Florida, and other retirement-heavy areas could see significant price pressure as supply outpaces demand. Savvy investors are already positioning for this. They're identifying markets with economic diversity, strong population growth across age demographics, and infrastructure to support continued expansion. They're avoiding over-concentrated retirement markets that lack younger buyers and economic resilience. Estate sales and probate properties will also surge, creating opportunities for investors who can navigate the complexities of purchasing from estates. These sales often come at discounts because heirs are motivated to liquidate quickly. But timing and patience are critical. Policy and infrastructure implications shaping future markets. The silver tsunami isn't just a housing story. It's reshaping infrastructure, healthcare, transportation, and public policy in ways that will determine which Florida markets thrive and which struggle. Counties and cities with the foresight to invest in senior-friendly infrastructure, public transit, healthcare facilities, and affordable housing will attract continued in-migration and maintain housing demand. Those that fail to adapt will see their senior populations age out, younger residents avoid moving in, and housing markets stagnate. Healthcare infrastructure is particularly critical. Retirees prioritize proximity to hospitals, specialists, and urgent care. Markets with robust healthcare networks, like Tampa, Jacksonville, and South Florida, have a structural advantage. Markets with limited healthcare access will struggle to attract and retain seniors, especially as medical needs increase with age. Transportation is another factor. As seniors age and stop driving, access to public transit, ride-sharing, and walkable amenities becomes essential. Communities investing in senior-friendly transportation options will remain attractive. Those that remain car-dependent will see seniors leave or become isolated, reducing quality of life and housing demand. Policymakers are slowly waking up to the challenge, but action is lagging. Affordable senior housing development is woefully inadequate. Zoning reforms to allow accessory dwelling units, which can house aging parents or provide rental income, are progressing slowly. And infrastructure investment is often reactive rather than proactive. For investors, following policy and infrastructure trends offers clues about future market performance. Cities approving senior housing developments, expanding transit, and investing in healthcare are signaling growth. Those ignoring demographic shifts are signaling risk. Strategic positioning for the demographic wave. So where does this leave investors and buyers? The silver tsunami is real, it's accelerating, and it's reshaping Florida's housing market in profound ways. But it's not a uniform trend. It's creating winners and losers, opportunities and landmines, depending on sector, location, and property type. The opportunities are clear. Single-family rentals in senior-friendly markets offer stable, long-term cash flow. Luxury senior living and memory care facilities are experiencing structural demand growth. Mid-priced condos in walkable urban cores are attracting senior buyers and renters seeking convenience. And distressed properties in fundamentally sound markets present value plays for sophisticated investors. The risks are equally clear. Affordable housing for fixed-income seniors is in crisis, creating instability in certain neighborhoods. Older condos with aging ownership and deferred maintenance are financial traps. Coastal markets with soaring insurance costs are displacing middle-income seniors. And retirement-heavy communities face inventory waves that could depress prices. The key is understanding the nuances. Florida isn't one market. It's dozens of micro-markets, each responding differently to demographic pressures. Investors who do the work, analyze the data, and position strategically will capitalize on one of the most powerful demographic shifts in American real estate history. Those who ignore it will get steamrolled. The 2026 housing market isn't just about interest rates or inventory. It's about demographics. And in Florida, demographics are destiny. The silver tsunami is here. The only question is, are you positioned to ride the wave or get swept away by it? If this analysis opened your eyes, smash that like button right now. Subscribe to Housing Intel for weekly data-driven real estate intelligence that cuts through the noise. Hit that subscribe button and ring the bell for real-time housing insights. And drop a comment below. Which sector are you watching most closely? Affordable housing? Senior rentals? Luxury senior living? Tell us in the comments. We read every single one. We'll see you in the next video, because sometimes knowing where the demographic wave is heading can be the best investment decision of all.